So for Australian markets, the Australian market was positive, but nowhere near what it was in the States. And we don't have that concentration in the IT sector like there is overseas, certainly in the US and also through Europe. So materials drove markets. And interestingly, if you dissect the market here, materials has been one of the better performing sectors, which is clearly a large part of the market here. IT's actually lagged quite significantly if you compare our IT market with what's going on overseas. So the overseas IT market's up sort of in the order of about 30% over the last 12 months, and our IT market's actually down about 15 to 20%. So, it really does depend on the constituents and the nature of the business. And that's a little bit of the AI taking over some of the software type threats that has sort of played through markets over the last period of time. Generally, there's limited impact that happens from the budget these days for equity markets. Clearly, there will be some investment decisions that will be impacting or on people's minds as a result of the budget. There's still a reasonable amount of uncertainty as to how broad the tax changes will be and how they'll actually be enacted. So we're still watching and waiting in some of that detail before we provide any sort of suggestions of anything that needs to happen. But certainly for clients to keep in touch with their advisors are a really important thing to keep close to. In the month, similar themes were prevalent through the month. So technology and AI-driven themes, energy was interesting, bond yields were interesting, which flows through into or from inflation and concerns around inflation still. And that's, I suppose, some of the AI, the technology, the trends there, and the inflation trends are what really drove and will continue to drive probably markets for the foreseeable future while there's a bit of uncertainty geopolitically. If you scratch below the surface, there's a lot more to it in terms of understanding what's in your portfolio, understanding where the concentration and risks are in markets, and making sure that you're getting a little bit of exposure to that, but you're not concentrated in some of those areas that will be more sensitive as markets turn very quickly, which seems to happen quite a lot at the moment. The top 8 or so companies, which includes the Apples and the Microsofts and the Amazons, it's about 30% of the US market. It's about $20 trillion of market cap in those handful of companies, which it's mind-blowing. They are certainly the winners and the leaders of what's going on in markets at the moment. So very much related to the AI trend, very much related to the potential growth from that AI trend, and obviously impacted in some ways positively if you think of NVIDIA with their chips, positively impacted by the spend that's going on in that sector as well at the moment. So, and I mean, if you unpack that a little bit, yes, it's a concentration. These are global businesses. Yeah, they're not just US businesses. So the way we run our business, we're very much Microsoft dependent, as are many, many other businesses, whether it's Microsoft or Alphabet, whether it's Facebook with Meta, whether it's Apple or Amazon. All these businesses are pervasive in other businesses, and hence why they've got such a big market share. We'll see a little bit more of that come over the next month or next few months with some IPOs potentially as well. So some of the AI specialists coming to market with public offerings. Again, numbers roll off the tongue, but trillions of dollars of market cap potentially coming to market. Now, not all of that will be liquidatable. Some of that will be not tradable, and some of it will be held by existing shareholders. But there will be some investment opportunities for some of the managers that we've got exposure to get some of that into their portfolios if they perceive that it's worth having exposure to. So we look at fixed interest markets now. So cash rates in Australia did rise at the start of May. So the central bank here was still cautious on inflation and that impact from energy price increases through what the conflicts and the extension of the conflict in the Middle East, which still seems uncertain as to what the direction of the outcome of that will be. Interestingly, if you look at longer term bond yields, the 10-year yields generally were a bit lower through the month. And I think that was probably a little bit of an adjustment of markets, sort of suggesting that inflation will probably start to get some positive signs and hopefully get back under control of the central bankers. The conflict will have an end at some point in time, so peace talks or ceasefire talks, I should say, have been in place and hopefully will be extended, with hopefully some resolutions coming through, which then clearly has a bit more of a positive impact from a longer term inflation piece, which is starting to play into bond yields and lower yields, which is positive for returns in that part of the market.